This is one of my best valuations. I don't like these numbers, but there's a but. As you saw in the preview, I have an Excel file which I use to value stocks and see if the valuation makes sense after my fundamental research. In this video, I'm going to share with you the numbers behind Apple's stock and Apple's valuation. You can just jump into this timestamp if you want to see the results, but I believe you have to wait and see how I get there in order for you to make the best conclusion from those outcomes. There are a few metrics that we have to know in order to get an outcome from this valuation method. First, and the most obvious one, is the current market cap. The current market cap for Apple as of right now is $2.634 trillion. Second, past 4 to 5 years revenue numbers. You can see the historical revenue numbers here. Third, a range of profit margins for this company. Here is a range of profit margins for Apple since 2016, or you may want to call it the net profit margin. Right now the profit margin is around 26%. I don't see them improving that number, mainly because of the inflation. That's why in general a lot of macroeconomic investors are pointing out to this inflation problem like this guy. Let me explain more. When inflation happens, dollar loses its value, so the price of goods goes up. For example, if the cost of aluminum in Apple product was $100, because of the inflation it's now $110. It's not just aluminum. A lot of things are now more expensive because of the inflation. So now you may say Apple can increase the price tags on its products to kind of compensate the inflation effect on its profit margins. It doesn't work like that. You see, as the price of goods are going up, a lot of people now have to spend more for things that they have to buy. For example, people have to buy food in order to be able to live, continue living. So these are the necessities that are going up, while the wages aren't changing that much. So the wages aren't covering the inflation. So what we have here is a bunch of people making the same amount of money while their expenses are going higher. So they don't have any money left over to buy tech products like laptops or things like that, or a new phone. So Apple is now thinking we can increase the price tags, but the majority of people are going to be struggling in this situation. And we may lose some customers. For example, somebody is looking at iPhones, they are $800, so they think we can get this Android phone for $300. So they move to this Android phone and they may never come back. So I believe that's why they're gonna keep their prices the same as you have seen with iPhone 13 or a lot of other products. They are not increasing the price tags on those. So in short, this is going to be a reason against profit margins of this company in upcoming years. There is another reason behind my thought that I believe the profit margins are not going to improve anytime soon, which I will explain in a few minutes. So let's get back to what we needed for this valuation. The first one is the historical P ratio for this company. You can see here the historical P ratio chart for Apple stock. I know a lot of investors are interested at Apple because of the Apple car and things they have been seeing and or hearing about the Apple car. There are a few points that I want to mention. First, I have to say that I'm not a big EV believer. I believe hydrogen fuel cell electric vehicles have a real opportunity to live along with the EVs. I have a master's degree in renewable energies and energy management, so I have researched a lot about this topic. I know that they have a real opportunity. However, in my valuation, I'm going to create a scenario in which I will consider the Apple car and the Apple car numbers, revenue, sales, and things like that. So for those who are interested at that and they are a big believer on Apple car, you can also see what upsides that can potentially bring to this stock. One last thing that I want to add here. If Apple successfully enters the car manufacturing thing, for the first 5 years, I believe it's going to be mind-blowing. The numbers are going to be mind-blowing. Because there are a lot of people that they love just Apple. They love that logo, Apple. So we're gonna have a lot of Apple fanboys. They're gonna just buy Apple cars left and right. So the revenue numbers, in my opinion, is going to be mind-blowing for the first 5 years. There are a lot of potential upsides if we really consider the Apple car. The upsides are unbelievable. I will explain more about these upsides later on this video when I'm talking about the numbers and the potential revenue numbers from the Apple car sales, so stay tuned for those numbers. Okay, so I've already entered the market cap for Apple. As you can see here, $2.634 trillion, not billion, trillion. And I've also entered the revenues from 2015 to 2021. I have used the forecast method to forecast the numbers from 2022, as you can see here, to 2030. Here is the forecast sheet. Last time when I was doing the course evaluation, I used the lower confidence bound as I explained in that video because of some short-term things that was happening with Corsair, and the forecast method uses the last 4 to 5 years revenue numbers. I wasn't that confident with those numbers, but for this case, I'm definitely not going to use the lower confidence bound. I'm either going to use the forecast or the upper confidence bound. I don't know which one I'm going to choose. So I've annualized the returns for these two methods. These are the results for the annualized returns, as you can see here. The revenue growth for the forecast method is 6.78% annualized, while for the upper band, the annualized revenue growth coming from the forecast method is 7.81%. I believe Apple's revenue growth is going to be in line with upper bound numbers, so I'm going to use the upper bound for this valuation. As I showed you the historical profit margins before, the profit margins can go as low as 15% to as high as 30%. But the normal range for the profit margins for Apple is around 21 to 24%. I don't think we're going to ever see 30% or 15%. 15% is more likely than 30%. Yeah, 30% is really high, but still they are possible. But the normal expected range is going to be around 21 to 24%. I've also made a column here for the Apple Car, which I will discuss later. For the Apple Car, the profit margins, in my opinion, is going to be around 19%. It's really hard to just say profit margins because we don't know how much they're gonna spend on the R&D, and we don't know how many cars they are gonna sell. We have no idea. So don't expect the Apple Car revenue numbers to be exact. Okay. Those are not exact, but anything other than that, I'm really confident of the numbers that I'm entering here. So for the historical P ratio, as I showed you before, I've entered these numbers. Obviously it can go as low as 5. It is very unlikely, but it is possible, and it can go also as high as 45 if nothing big happens. For example, if the Apple Car comes out, that hype can potentially increase the P ratio, as I explained before, but this is the range that I'm choosing. For the mid-range, it can go as low as 15 or as high as 30. In this chart, you can see the P ratio for Apple can be just all over the place. So I believe this is a factor that can affect Apple's stock price in the short term. For example, in 1, 2, 3 years. The PE ratio is going to be the main factor that moves the stock price, in my opinion. It's not going to be the revenue or EPS, in my opinion. In the short term, yeah, I think the PE ratio is gonna move the stock price. Anyway, for the Apple Car, the PE ratio that I chose is 75. For Tesla right now, they're not selling that many cars, and the stock price is high, or the market cap for that company is high because of all of the hype and expected revenue growth for the upcoming years because of the car sales. I believe it's going to be the same for Apple. People are going to increase the expected revenue numbers when the Apple Car is about to come out. So the P ratio can potentially go up to 75 in that scenario, in my opinion. So these are the potential returns. Okay, and there's a lot to explain here. Before everything, I have to say, I believe this is one of my best valuations that I've ever done on a stock in terms of numbers being right, because the numbers that you're seeing here, I really believe these are potentially the numbers that we will see in the future. The middle bad case and good case scenario annualized return, as you can see here, potential returns on this stock for the upcoming 10 years is going to be right between these two numbers. That's my opinion. We're gonna start now with the worst case scenario. For the worst case scenario, we had the P ratio of 5 and the profit margins of 15%. So it is unlikely because they're gonna grow revenue 5%, between 5 to 10% every year. So the P ratio, I don't think is going to go low or as low as 5 because, well, the Apple's transition to silicon chips is a big deal. And yeah, I believe the P ratio is not going to 5 anytime soon, or the profit margins are not going to 15% anytime soon because, well, as I said, they are not buying Intel chips, or they are just manufacturing everything on their own, and their profit margins have been going up for the past few years. So yeah, this is a scenario, but really unlikely. For the best case scenario, It's the same. It's almost the same as a worst case scenario because we have a P ratio of 45 and the profit margins of 30. With the profit margins are with this inflation that we're having, it's really unlikely. It's really unlikely. Maybe in 3 or 4 years we will see the 30% profit margins, but in 1 year or 2 years, I don't think so. For the PE ratio 45, well, P ratio is not going to 45 anytime soon unless investors expect this company to do something innovationy like Apple Car or something new that is going to increase the revenue growth for the upcoming years. So that's going to increase the P ratio, in my opinion. It's unlikely. Unless for the Apple Car case, it's unlikely, but it is possible. It's Apple. When they introduced the Apple Silicon, their P ratio jumped as high as to 30, as you can see in this chart. That was an innovation. The more innovation that they do, the higher their P ratio can go. But I don't think anytime soon the P ratio is going to 45 because 45 is a lot. 45 is a lot for a tech company that is expected to grow around 5%, 6, 7, 8, 9%, or 10% every year. Yeah, 45 P ratio, it is high, but yeah, it's still possible. These two scenarios, bad case and good case scenario, are the most likely scenarios in my opinion. So the range for the profit margins for these two is between 21 to 24. Obviously, that's what the profit margin has been moving around for the past few years. The P ratio is the same. It's around 15 to 30, which again is the same range that the P ratio has been moving around for the past few years. As you can see here, the annualized return for these two scenarios is interesting. For the bad case scenario, all of the annualized returns are negative, and for the good case scenario, all of the annualized returns are positive. Thank God. So I'm going to mainly focus from 2027 to 2030. The annualized return for the good case scenario, not the middle case scenario, for the good case scenario is going to be around 7%, which is right on the line with the S&P 500. 7% for the good case scenario. It's bad for me. It's bad for me. It's a good case scenario. It's not a middle case or bad case scenario. It's a good case scenario. And I'm not going to invest a lot of money in a stock to get 7% return annualized. For me, I want to outperform S&P 500 returns, and this number should be at least 15-20%. 15-20, yeah, because it's a good case scenario. It's the scenario that if everything goes as I expect. So yeah, this is not good for me. I don't think I need to explain the bad case scenario. Negative returns. So I have to say why these numbers are negative. They all go back to the P ratio. Right now, the P ratio is around 30. And historically for Apple, it was less than 20. So in these numbers, as you can see here, the P ratio can go back to 15. No matter what the company is doing. If the P ratio goes back to 15, we can potentially see the negative returns for a long time. So yeah, I don't like the numbers. I don't like these numbers, but there's a but. Apple Car. As I explained, I'm going to enter some Apple Car numbers, and as you can see here, the Apple Car is not going to be out anytime soon. So I'm going to only use 2 years, 2029 and 2030. In this scenario, which I didn't use the Apple Car sales, the revenue for 2029 and 2030 was 637 billion and 667 billion. But in this case, it's 700 and 850 billion. So the profit margins, as I explained before, they're going to be down because they're going to spend a lot of money to build a lot of infrastructures for car manufacturing or things like that, or research R&D. So the profit margins are going to be lower than what I entered here. It's going to even be lower than the mid-low. The P ratio, however, is going to be super high because starting, for example, 2029, the Apple Car sales are going to be included in the revenue. So the revenue is going to grow a lot comparing to the previous year. So investors are going to be hyped and the P ratio can jump up to 75. This is just one scenario that I'm just entering some random numbers. You can't value Apple in 10 years. It's really difficult. I can say it's almost impossible. But in this scenario, the market cap is going to be around 10 trillion. But in that scenario, the market cap can be around $10 trillion. So as you can see, the annualized return in that scenario can be around 18%. Well, that's something to keep in mind. 18% is a good return. Even for me, it's a great return. And this is not the best case scenario. Don't look at it if it is green. It shouldn't be green. Let me change the color. It's not the best case scenario. Don't look at the green. It's a normal case scenario. So yeah, 18% is good. It's great, but there's a but. For those Apple car bulls, as you can see, if you hold the stock for 10 years, you can get an annualized return of 18-19%. But why would you buy this stock or this company right now when the valuation is already expensive, in my opinion at least? There aren't going to be any Apple cars anytime soon. So for me, this stock is not a buy. I know as a long-term investor, we have to have a long vision or things like that. But yeah, 10 years is too much. 10 years is too long, and a lot can go wrong in this period. I'm going to watch this stock, and I don't think I'm going to like the valuation anytime soon until maybe 2023 or 2024. I expect the valuation to come down in that period, and I hope that I can find other stocks that I get better returns in this period. So if I have 1000 right now, I can buy, for example, 4 shares of Apple right now, even though Apple is going to be more expensive probably in the future, but I'm going to get better returns from buying other stocks or investing in other stocks. And in 2 or 3 years, instead of me being able to afford only 4 shares with that money, I'll be able to afford 5 shares with the same amount of investment if I buy other stocks and hold them for 2 years until the valuation makes sense for this company. So that's how I look at this stock. So yeah, this is definitely not a buy for me right now. This would be a buy for me, let's say, if the market cap was. I have to create another thing here, just entering the share price instead of the market cap. But let's say if the market cap was, give me a second. As you can see, if the price drops 20%, if the market cap drops 20% for this company, the annualized return for the good case scenario for this stock is going to be around 10% for me. Again, not good. I'm not going to buy this stock if the stock price drops, as you can see here, 20%.
Is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
So what about 40% or 50%? So 50% is so if the stock price drops 50% from where it's standing right now, which is really possible. It's really possible. It's just the P ratio. For example, right now the P ratio is around 30. If the P ratio cuts in half, let's say it goes back to 15 where it was before. It was around 15 before. So if the stock price cuts in half, the annualized return for my valuation is going to be around 16% in 10 years or 20% in shorter period. For example, by 2026, if we hold this stock by 2026, it's going to be around 25%. That's great for me. So if the stock price drops 50%, I'm going to consider buying Apple. That's it, guys. I'm not buying Apple anytime soon. Hit the thumbs up if you like the content. I'll be posting more videos like this every week. Comment down below if you have any questions. I'll gladly answer them. See you with the next video.